This week sees the US jobs report coming back into focus following last month's shocking 12K NFP figure. Well, we saw a massive disparity on the ADP number and that headline payrolls figure, and markets are trying to gauge whether this is something that is indicative of an underlying problem with the US jobs market or something temporary in nature. So let's look into exactly what we're expecting for this coming jobs report and how it could impact the likes of the S&P 500 and the US dollar. So here's the breakdown in terms of market expectations according to Trading Economics. What we can see here is that we're expecting to see a rebound, very significant rebound from 12,000 up to 194. I think probably equal to that headline figure is going to be equally in importance is going to be any potential revision to the prior month's number. Worthwhile bearing in mind that we have just seen the ADP payrolls figure and we did see an a downwards revision to that figure. Of course, last time it was 2,033,000 we saw on the payrolls, which stands in stark contrast to the 12K number. Well, instead, we've seen that 233 revised down to 184. So already a major downward revision to the ADP number. Are we going to see an upward revision to the NFP number on Friday? Aside from that, unemployment expected to remain at 4.1, the average hourly earnings down to 0.3 on a monthly basis, but remaining steady at 0.4. Participation rate remaining the same. These are expectations. And the U6 unemployment metric remaining at 7.7. So by and large, I think that the big mover is going to be the likes of the payrolls number, and also people will be keeping a close eye on the average hourly earnings figure as a proxy for inflation. As we can see here in terms of the breakdown for where jobs were created or lost last month, you can see that the sort of figures that are sub sort of zero mark, which essentially means that the areas where jobs are lost rather than created are heavily focused in the likes of trade, in the likes of manufacturing and professional and business activity. On the upside, you can see that it's being propped up by the likes of education and health, but also government jobs. And certainly, you know, if you're looking at a healthy economy, you're not necessarily reliant on government jobs. And there's an expectation that we will likely see that element fade, as we've seen with the ADP number. Crucially, ADP saw weakness in terms of manufacturing jobs. And we also saw a drifting off in terms of government jobs. And I think that, you know, government job creation in the lead up to a changeover at the White House is likely to be less prominent. So certainly we're expecting or hoping to see a pickup in some of these other areas of the US jobs market. Here's the ADP payrolls and the sort of comparative between the headline and the ADP number. You can see here that we've actually on this chart revised down to that prior month's figure. So the comparative between ADP number and the non-farm payrolls figure on the headline number isn't as bad as it looked at the time, but certainly 233K on the ADP number and then 12K on the headline number really highlights just how wide of the mark the ADP figure can be when you're using that as a barometer of where we expect to see that headline number moving. But we've seen a moderation in terms of the prior month. So are we going to see a moderation in the opposite direction in terms of the payrolls figure? So we're going to get an upward revision from that 12K. And then we've seen a sort of downwards move in terms of that ADP figure. So what we're going to see in terms of the payrolls figure this time around. Now, revisions by and large over the course of the past year and a bit have generally been negative in nature. But with the fact that we're looking at a 12K figure this time, are we finally going to see a strong upward revision this time around? Certainly, we don't want to see a negative revision because it might take us into negative territory. And so certainly if we were to see that, you know, we're teetering on the brink. If we see a revision downwards and we see it moving into negative territory, you know, that's the kind of thing that could really grab the headlines. In terms of some of the other sort of things we'll be looking out for, inflation is absolutely critical at the moment. Market expectations for the Federal Reserve have been reined in pretty significantly, in part due to Donald Trump coming in and the expectation that he's going to be inflationary by nature with the fact that he wants to spend more. And therefore, markets are now pricing in less rate cuts, less and less and less for 2025. And so that shift could potentially influence market sentiment going forward. We can see here in terms of the wage growth figure, we have started to see it sort of stutter in that downward trajectory. We can see the relationship between the average hourly earnings figure, which is the light blue figure, which is 3.99, and then that core CPI figure. You can see a close relationship between the two, and both of them sort of struggling to really make any further headway towards the downside. And that's what we need to see. We need to see continued weakness in terms of wage growth and weakness in terms of inflation to allow the Federal Reserve to do its thing. If we don't necessarily see it, and if we see an expectation that the economy is going to be pushing upwards in lieu of potential action from Donald Trump and increased spending, then you don't necessarily have the justification for any sort of drastic easing from the Federal Reserve. You can see in terms of the 3-month annualized growth rate at the bottom section, last month actually saw that tick up above the area where we want to be, the sort of pre-pandemic area that I've shaded with that grey band. We did see the JOLTS job openings number coming in better than expected earlier in the week, but the trend is certainly still downward. And you can see that by the orange line that we've seen this uptick, but the trend is very much geared towards further weakness in terms of job openings. We can also see that relationship between quits, which, if someone quits, then generally they would feel optimistic about their hopes of being able to find another job versus being laid off or discharged, which of course is generally what happens when you're not in a great position as an employee. And so we actually saw a rebound within this latest report from the JOLTS report. So we saw an increase in quits relative to layoffs and discharges. So that does actually provide some hope that the jobs market is in relatively decent condition. You can see that despite recent claims over the course of the sort of second half of this year that we're heading towards a recession, that certainly hasn't happened. We haven't seen this huge spike in terms of unemployment, the so-called SARM rule that everyone was talking about. And so as long as unemployment remains steady and around the area, the 4% mark, which is what's expected, then, by and large, payrolls are likely to stay around your 100 to 200K mark. I think, with the fact that inflation still remains a problem and the fact that we've got wages where they are at the moment, it points towards a strong likeliness that the Federal Reserve will take a relatively cautious approach. Now, this is the relationship between the Citi Economic Surprise Index and the 10-year yield over in the US. Now, by and large, the two have been moving in tandem. You can see that for the second half of 2024, we've actually seen sort of better than expected economic data coming out of the US. That started to turn a little bit recently. And so what we can see here is essentially that when we see economic data that comes out weak or weaker than expected, we're also seeing that influence the 10-year yield. Now, the 10-year yield is also a reflection of where people think that rates are going to go. So there's this perception if we see weak economic data, it's going to force the hand of the Federal Reserve into cutting rates at a faster pace. Now, in terms of that trajectory of the 10-year yield, well, the 10-year yield relative to the likes of the dollar index highlights the idea that when we're seeing yields relatively elevated, i.e. a perception that we don't necessarily see the Federal Reserve cutting too much, then that props up the US dollar. It's the time when we think we're going to see huge amounts of rate cuts from the Federal Reserve that we see the US dollar losing traction. Now, that will be relevant when we look in a sec at the likes of euro dollar, because the ECB are certainly expected to cut rates at a higher pace than the likes of the Federal Reserve. And that brings us onto this final slide, which is essentially pointing towards the fact that we've actually moved into a period where we're not seeing a huge amount of movement over the course of the past month when it comes to expectations from the Federal Reserve. This is for the October 2025 meeting. So essentially in a year's time from now, where are we going to be? And you can see that, the base case scenario is down to sort of 375 to 400 band. But what's notable here is that we haven't seen a huge movement around that at all. We've seen sort of easing in terms of expectations that we're going to see rate cuts over and above that. And we have seen a growth in expectations that we could potentially see less than that. So we're seeing movement around the edges, but the base case scenario of 375 to 400 is sort of roughly where we are at the moment, and we have been for the past month. So let's look in terms of market expectations and market movements and how that could shift sentiment within the likes of the US dollar and the likes of US stocks. So first and foremost, we're going to jump on to the chart for euro dollar. And euro dollar is really key because we're talking a second ago about the fact that essentially the strength of the US dollar has come off the back of this stronger than expected data for the most part, with that City Economic Surprise Index rising, the rise in terms of the 10-year yield, the expectation that the Federal Reserve will likely do less when it comes to easing. That isn't necessarily the case in Europe. The ECB are expected to continue to ease. And you can see here in terms of the weekly time frame, we can see that this breakdown through your support level on euro dollar, which was set here in October 2023, the break through that level does point towards a strong possibility that we've essentially topped out here. So we saw this rally coming into play, but from a wider context, you can see that very much this is a bearish trend. It's just a very long-term trend. So it's very easy to just get stuck in the mud and sort of only focus on the near term. But look, ultimately, everything that's been playing out over the course of 2023 and 2024 looks like a likely topping pattern before we roll over once again. In terms of the fib, I mean, it's kind of irrelevant now, but you can see here that it's hit that 61.8 fib, then come up towards that trendline resistance. Now falling over in a meaningful manner towards the downside. We have tentatively broken through this 1044 support level, but we've now rebounded, starting to roll over once again. So I think there's a good chance that we do see the bears sort of taking hold of this once again, but certainly a move back below this 1044 and 1033. Those are the kind of things that really give us greater confidence that that's the direction of travel. Now, the key thing here is that, whilst we do have different expectations when it comes to what the Federal Reserve are going to be doing and what the ECB are going to be doing, it's worthwhile noting that markets are going to be moved based on shifting expectations. And so if we start to see expectations of increased rate cuts from the Federal Reserve, then even if that's still less than the ECB, we could still see the likes of euro dollar picking up as a result. So what might drive euro dollar strength? Well, it would be the possibility of weak inflation, which would be born out of that wage growth figure. So if we come in with weak wage numbers, or the possibility of a weak economy. Now, that 12K figure from last month on the payrolls number, if we saw another weak figure or a downward revision to that 12K number to move it into negative territory, that's the kind of thing that could shock markets. And certainly, markets are only willing to look at the prior revision and be shocked by it if it also is followed up by another weak figure this month. I mean, if we see a bumper figure for this month and then the prior number got revised down slightly into negative territory, we're probably just going to see it sort of netted out. So it's likely we'll see the two netted out in the minds of the markets. But certainly if we see further strength in terms of the wage number, which is by and large expected, and if we see a pop in terms of the payrolls numbers and an upward revision in terms of the previous numbers, which is what is expected or what's likely, then there's a good chance we do see euro dollar rolling over once again. And this 10609 essentially is going to be the swing high that, as long as we don't break that level, then the bearish trend that has been playing out over the course of October in particular through into November, that does remain in play until we see that level broken. And then in terms of US indices, look, ultimately it goes up, right? I mean, certainly Donald Trump has been good for markets, but so has Joe Biden. We've seen an incredible 2024 and it continues apace. We're pushing up into record highs on a daily basis. We're moving up in towards this trendline resistance. So this does point towards a possibility this market's a little bit stretched to some extent. When you're talking about the possibility of it being stretched and potentially reversing, there's different indicators you can potentially use. One would be the Bollinger Band. So the Bollinger Band will sort of show you whether you're at extremes or not. So the top end would be the extremes. So you can be at the top end and keep sort of tapping along in a very strong uptrend and trending between the upper Bollinger Band and the 20 moving average. You can see sort of a rally into that Bollinger Band, the top end, and then a pullback into the middle one as support, which has happened a number of times before, and that often happens within a strong market. You see it perfectly providing support here. And every once in a while, you'll get that deeper pullback into the bottom end of that Bollinger Band, and you can see that generally it doesn't necessarily just tap that as support. It's often sort of a protracted move lower before the bulls come back into play. You can see the same kind of thing here. On these occasions, we have just tapped it. So mixed affair on the lower end here. At the moment, we're up around that upper Bollinger Band, around this trendline resistance. There's a good chance that we do pull back at some point over the near term. And certainly if we were to see a strong wage figure in particular, then that would be a sort of warning sign for markets over the resurgence of inflation. I think a big rebound in terms of inflation is probably the biggest risk for markets, quite frankly, because it would pretty much just start to write off rate cuts as a whole. So, you know, certainly the trend is bullish, and we can see in the 4-hour and hourly time frame that, you know, we just continue to move upwards. So high highs, high lows are key here. And certainly if we're looking towards the downside, move down through your sort of 6033 would negate this near-term uptrend. But that uptrend on the hourly time frame is really key here. As long as that's remaining in play, then we're expecting to see further gains. But if we see that end with a breakdown through the price swing low, which on this occasion is 6033, then we could see a pullback coming into play. And given the fact that we're relatively stretched at the moment, we're back up towards that trend line resistance and the upper Bollinger Band. You know, if we did see a pullback as indicated through that hourly time frame break through 6033, then you'd be looking at support coming once again from that 20-day moving average, which at the moment is at sort of 59.81. But of course, it's a dynamic indicator, so it will move as we go along. So the uptrend that has been dominating over recent weeks still remains in play, but be aware of the fact that, you know, we do have this area of resistance. And if we see a breakdown on that intraday basis, it points towards a possibility of a sort of few days of weakness to pull us back potentially into that 20-day moving average. So I hope this has helped. It's going to be an interesting report over the course of Friday as we move into, or we move through a month that, of course, is going to sort of die out in terms of volumes and potentially volatility as we move towards the back end of the month. But certainly the beginning of this month, really busy time indeed, with a lot of interesting decisions from central banks coming up soon as well. But this week is a key one, with the, of course, key part of it coming in the form of this US jobs report taking place on Friday.